I am your host, Josh Appleman, founder and CEO of Appleman Properties. Today, we are joined with Brian Briscoe. Brian is a retired Marine and founder of Streamline Capital Group with over $100 million in apartment assets. He also mentors in multifamily investing and hosts the podcast Diary of an Apartment Investor.
Okay.
Brian, we're excited to have you here today. Can you tell the audience a little bit more about yourself?
Yeah. Hey, thanks a lot, Josh, for having me on the show. I appreciate it. Well, yeah. So, I mean, you mentioned that the 20 years retired from the Marine Corps. That's kind of where I really started with with real estate. It's been almost 20 years from now ago that I read that Rich Dad Poor Dad book. Like a lot of people, I think that started a lot of people along the path of investing. Um, and I remember reading through the book, and he talks a lot about multifamily in the book. And real estate had always interested me. My buddies and I in high school used to always dream about, you know, buying big properties and whatnot. And man, I wish we could own that movie theater type stuff. But so it had been something that was always on my mind. But at the time, I didn't know how to do it. It was just like, I think this is a bridge too far. So what I started doing is just trying to buy single family homes. And while I was in the military, I moved 10 times in 20 years. And every time we moved, we look at the feasibility of, okay, is where we're moving to, is it feasible to buy something and be able to rent it out, and at least break even. And every time I could answer the question yes, when we moved, we would buy a house, and 2, 3 years later, when we moved again, turn it into a rental. So um, that's how I got started with real estate. And we were only able to get like 3 single family investment homes, which is better than nothing. But I I got bit by the bug, so to speak, and I started looking at how to scale that. I saw my equity getting larger every year, and timing wise, oh, by the way, my first property was before the crash. So and then second two were after. So I kind of had a little bit of exposure to what happens to real estate during downtimes. But um, anyway, long story short, when I could start seeing the light at the end of the tunnel in my military career, and I made the decision to get out at 20 years. I think the last 3 years of my active duty career, I was showing up to the Pentagon every day to do my 9 to 5, which Pentagon's never a 9 to 5 job, but I was spending every waking minute outside of the Pentagon, basically building, the start of a multifamily portfolio. So, retired just over 2 years ago today, and do this full time. It's something I love doing. I've co-founded a company, left that company a year ago and co-founded a second company. So we're on iteration number 2 for, I guess this is like career number 3 for me, but it's the same thing as the last one. But anyway, long story short, that's where I'm at right now, and
That's
how I've gotten
incredible.
here so far. Yeah.
It's incredible that you started out with a career and
Mhm.
then with it's just a single family home of where
Yeah.
you're living, turned it into an investment property, and then another one, and then now you've got over $100 million of
Mhm.
assets under management apartment complexes.
Yeah.
Um, what tell us if you could about the first deal apartment
Mhm.
complex and then the gap of from getting it to where you had to get yourself in order to get it.
Yeah. So the first deal, I mean, a lot of it was convincing myself that I could do something that size. And I had lived in some expensive areas, so I mean, like the single family homes I bought weren't cheap. The first one was 200,000 purchase. The second one was like 300,000. This is like 2000 something. But the single family portfolio I had, if you had all the values of all three together, were about 2 million. But in all three of them together, I think I put less than $50,000 down, right? So because I was the owner occupant, it was a lot easier to get into those homes with a very low down payment, which is
Yeah.
how I was able to do it. So going into multifamily, and I've syndicated most of the properties. We've got a couple of properties where with 2 or 3 guys and gals, there's um, but where two or three people have come in and just purchased properties. But part of it was convincing myself that I could do it, and I listened to a lot of podcasts, listening to other people's stories. And every time I hear somebody else who's just a normal guy, it's like, all right, this really normal guy was able to do this. Maybe I can too. But once I got over that hurdle, I joined a coaching program, which really helped, and met a couple of guys, and we ended up creating the first partnership that I was in. And the first property was, a 2-for-1 sale type. I mean, it was a group that owned two properties that were right by each other, about a mile apart. I mean, so depending on your definition of right by each other, but about a mile apart, both in the same city, both in like the downtown area of Spartanburg, South Carolina. And we negotiated a purchase price of 4 million, and we had to raise about 1.5 million. I mean, going into it, we thought would have to raise 1.5 million. And this was a time, 4 or 5 years ago, where the interest rates went up.
Yep.
We were expecting a lower interest rate. We were expecting like a 3.9, and we ended up closing at a 4.9. And so, a lot of our numbers went the wrong direction. But looking back at it, we made a whole lot of mistakes. And both on the underwriting side, on the management side. That property, and we ended up closing in October of 2019. It took us 6 months to close, which, something, the capital raise is something, we weren't prepared for. We thought we were. But anyway, it ended up being a marathon, closing period. We finally got it closed, started renovating units, and then COVID shut everything down. And anyway, that property was a huge learning experience for us. It ended up having kind of sort of a happy ending. We did sell that about 8 months ago. And, we gave our investors roughly a 10% annualized return, so it wasn't what we projected. It wasn't as great as we thought it was going to be. But, we were able to salvage, and we learned a ton. Unfortunately, this is kind of the downside of the business, and why I always suggest people start small on their first properties for people who are trying to syndicate, is because that first property is going to be a learning experience, and I'd
Yeah.
rather, cut my teeth and learn with $1 million of other people's money than $10 million or $20 million of other people's money. But fortunately, we exited. We were able to give our investors, their capital back, and a 10% annual return. And at the time we sold it, like early 23, there were a lot of deals that were selling where people were losing money because of where we are in the economic cycle right now. So ended up being a very qualified win. Like, I guess, so that was how that one panned out. And that's one of two properties where we didn't actually hit our numbers. You know, everything else we did were, great stories.
But ultimately, you surround yourself with other people in the industry, and you all combine knowledge to where you could bounce off each other to make it a win. Is that correct? Brian, are you still with us? I think we lost Brian here.